one thing I was going to ask you. Well, so I guess this is probably part of it, but the point on a lot of hedge funds, the way they're set up now is they really can't have a drawdown, right? Drawdowns are very limited. It's in some cases 5% below your asset level.
So one major pod shop is 3.5.
3.5.
If your portfolio goes down 3.5%, you lose your seat. You get fired.
And often in times, which I think maybe we're in right now, you start to see some wonky action in stocks, right? And we're already obviously seeing in GameStop, AMC, some small retailers, but this idea that some of these books are going to be completely unwound, like what should we be watching for? What else should we be seeing? Just kind of more of the same type of action.
Yeah.
Is there does this stuff happen on a Friday typically?
No, it happens. It's certainly on the second and the third day.
Yeah.
Because one is jolting. GameStop up moon. That's day one. Bunch of fundamental hedge funds come in. McGough did exactly what I wouldn't do, which is I'd short that, right? I mean, and then the next day he's I don't know, it doesn't make any more sense. So day one, people get smoked.
Yeah.
Day two, they get smoked more because they put more capital on the same trade.
Yeah.
Halfway through day two and into day three, they're like, oh fuck, I got to take this off, or my boss is making me take it off.
Yeah.
So on a very short-term thing, today, day three. Now, if we go beyond day three, we're going to go beyond the pale for some of these people, and they won't be working where they're working on Friday. Right? Because we're going to be on Friday, and then it's going to be like, oh, this can't continue, and if it continues, it continues. So I'd stay with what the market's doing. So what I look at, Jonesy, is all of it. Like, the days of saying it's one thing because you need it to be one thing to watch, those never were, never mind. Like, look at the volume. Thank you. 617 million shares of AMC traded yesterday. The average beside that is 22 million shares. The average trading volume of GameStop is just inside of 8 million shares. It traded 204 million shares.
Okay, so that's not all retail. That's not all retail.
No. That's not retail. That's hedge funds getting evacuated from their positions.
Or, and we saw this with the original GameStop, or hedge funds, or even long onlys on the other side pushing it, right?
Right.
So you have this, the squeeze.
It's all, of course. So in the early look note this morning, I said, if I had to, gun to the head, I have to make a move here. I can't do nothing. If I had to buy or sell a meme stock on a dip, what would I do? I'd buy it. So then I go through it, and I show the fractal. This is the second point I was going to make anyway, which is GameStop. So I show the fractal pattern that is GameStop. Fractal pattern. Again, I still don't know why people use simple moving averages other than it's simple. And they need something simple because they can't do this, right? So on GameStop, 1, 2, 3, all right? On GME, and I was using copper. Okay? On trade duration, trend duration, and risk range. So Jonesy, what do you look for? I look at that. If you ask me a question about anything that I can or may not trade, that's what I'm looking at. I don't look at anything else. I don't look at the stars. I don't call somebody. No, that's why I built it, so I don't have to ask anybody. I want to be an independent assassin out there. I want to have my own view, right? I don't need somebody else's view. This is what I need to know, right? So on these two things, bullish trade, GameStop, yes. Copper, yes. Bullish trend, yes. Yes. Risk range equals higher highs for both, yes. Yes. That's the same fractal pattern. Bullish trade, bullish trend, higher highs in the range. So GameStop's risk range today, I mean, if GameStop closes at 58.89 today, nobody should be surprised. That's the top end of the range. I don't think it's going to close there, but I'm just trying to trigger you a little bit, make you think, right? So 22.23, which Brian McGough said on the first day of this happening that anything over 20 is egregiously overvalued.
Yeah.
That's the low end of the range, right? And 58.89 is the top of the end of the range. Once things start going up faster, after they were at their prior top end of the range, that's called, again, people getting squeezed and or people chasing it at the same time, and most importantly, the machine perpetuating those behaviors.
Yeah.
Okay? So copper going to 505 in a hot minute, that's not normal, right? But what is normal in quad 2 is these types of things happening. So what we should look for is more of the process. That's what we should look for.
So taking the other side, and the other thing, maybe you mentioned this, but the implied volatility for GameStop is 700 or something, right? So like that of course is what leads to the risk range being whatever that is, $36 wide, right?
Yeah.
So but when you look at these things, okay, we'll all agree that GameStop's overvalued, right? Based on its fundamentals. If you're going to buy the company. But what do you need to see to think about shorting it or going the other way? Obviously, would it be breaking trade or trend or
shorting it? Yeah, like let's just say that a younger man shorted it.
Yeah.
And I didn't get fired because that type of behavior wasn't happening when I was screwing up shorts. Now, as you know, you've seen me short stocks at Dawson Sandberg, or what became Dawson Giamalva. You see me do it all the time. You've seen 8,000 timestamps. I've been squeezed before. I've been squeezed publicly more than anybody on the planet because I'm the only one with 8,000 timestamps going back to 08. So a former me probably would have shorted it.
Yeah.
And I'm trying to coach through the lessons learned of all my mistakes. I try to say it all the time, and because people are really, they're really soft in some cases. They're like, "You're talking to me." It's like, no, I'm talking to my former me, and I'm trying to help you. Okay? So, what would get this to happen would, one, you'd have to break immediate term trade, break that, and take this out and get. First of all, you need this anyway. This will happen first, lower high in the risk range. Then this happens. So number 1, this will happen. Number 2, this will happen. And then number 3, that will happen.
Yep.
And the whole time that that's happening, I got no problem shorting stocks. If the opposite is happening, why would I do that? Oh, because you got to be right. Intellectually. This is wrong. Clearly, Jonesy said, the valuation's wrong. Right? Like, think about these monkeys at the circus, like CNBC people. They always start with valuation, hitting a button on Yahoo Finance to look at the consensus, the multiple on a consensus number. I mean, that's literally, you could teach a monkey how to do that. Obviously, that's why they do that. But this is entirely different. This you have to learn by doing, okay? And you have to have the accurate and measurable tools to do it. And we're doing it. And we're proud of it, and I hope you're understanding it. Thanks for making me a better coach. There's a lot of things that I needed to work through before I could get to coaching you that way. But in the 3-step process, I think, Jonesy, that'll be what it is. And by the way, anything I hit the button on real-time alerts will have this profile.
Yep.
I'd much prefer to short something like that than get jacked for another 40 or 80% squeeze in GameStop. Are you out of your mind? Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.